Hey guys, how's everybody doing? Happy Saturday night. Hey Bond, thank you so much for being here. Sorry I was 4 minutes late. I was just trying to do too much stuff as usual. Man, Claude did a terrible job today. I was fighting with Claude all day. I mean, I should have had the top 40 show should have been on like at noon, maybe latest 2 or 3, but I mean, it wasn't on until just a little while ago. But Bond, you were there. I saw you there. Appreciate you for being there. All right. So let's see what's going on with the market. Last I checked, Bitcoin was looking really good. And I mean, which is good with me. Let's see. Did I share that? I know I shared that. All right. Well. Okay. Let's look at old Mr. Bitcoin because it's just about the only thing that's trading. Gold does trade 24 hours, but I forgot the symbol. My friend Mayer gave it to me. I believe it's gold to Ethereum, but it trades. What's that called? It's a token. It's probably tokenized, but in any event, and I forgot the darn symbol. Well, darn it, Bitcoin was up. I don't know, an hour ago or something. It was up, and now it's down a little bit. But whatever. Let's look at it this way, where I have my nice lines on the chart. I do not understand why the lines always disappear. I drew lines on this chart. Where did they go? It makes me angry. And I've redrawn them a million times, and I haven't clicked them off for anything. Man, well, whatever. All right, so but we can also check. It's far from official, but we can also check contracts for difference, which they trade at. Weekend Wall Street, which is IG International. IG is Tasty Trade's parent company. Yeah, and IG is showing the market down about 0.5% here. I guess they got Easter off also because there's a big. Yesterday, I kept looking at Weekend Wall Street. It was saying unchanged. I looked at it. I was like, no way. There's not unchanged. There's no way it's unchanged. And they were all unchanged. But I thought these traded 24/7, these contracts for difference that trade in Europe, which is like a futures contract. It's just I think it has similar mechanics. Well, in any event, they open back up, and sure enough, the market opened down a little bit. Let's go check weekend oil. Weekend crude and see where that is trading. That is up 2.2%, which explains why the market's down 0.5%, right? Hey, William. Hey, seriously, mad? Yeah, I'm hoping for a green start. We may keep bouncing for a few days. I mean, I know not right now. It's not looking like it, but the other day it looked like we were screwed with that big gap down, and we came shooting right back up. I've seen some people make convincing cases this weekend on videos. I think I shared one of them in Discord, or somebody else did. The bull trap could go on. It could get even trappier than, I wouldn't be surprised if it goes up higher. I wouldn't even be surprised if it takes back the 200-day just to get people all bulled up again. It did the same thing in March. We sold off under the 200-day. We were under the 200-day for like 5 days. Then there was a massive rally, and we took back the 200-day for like 2 or 3 days. And then, of course, then the other shoe dropped, and then we had the next leg down. So I need a little caffeine going on here. But yeah, thank you all for being here. So did you guys see the top 40? If you didn't, we'll rehash it really quick. We'll do a rehash of the top 40. All right. Top 40. Okay, there we have it. So it's already up. So USO was number 1, USOI was number 2, MLPI was number 3, and I got some of that this week. I mean, I probably bought the top in oil. I mean, but anyway, hopefully the pipeline stuff will be good even if oil goes down. But anyway, we'll see. I only bought a half-size position. If oil goes down or when oil goes down, I'll add more MLPI. I was considering XLEI. I was torn between these two. XLEI pays a little bit higher yield, but MLPI has a little bit higher NAV return. Just, you know, they're based on the same underlying. Just because of math, the high yield impedes the NAV return. Other things being equal. Look at this, MLPI was plus 13 points or 13 ranks. It was like number 16th last week. Anyway, then we had PDX. I was like, what in the hell is PDX? It's some kind of PIMCO, a bond fund or something. But heck, I mean, you know, it pays monthly and it pays more than a bond. You know, I think a bond pays 4 3/4 right now. The 20-year, 4.5, something like that. I guess we could just look and see what the 20-year pays. Yeah, 4.5. This is not the 20-year bond. This is a 20-year bond ETF, but it's close enough. So yeah, to be in the factor, you have to pay monthly or quarterly. We prefer monthly, but you have to pay quarterly. You can't pay yearly or semi-annually. And you have to yield more than a bond. And so bonds yield 4.5%. So that PDX is a pretty good little premium. You know, they're at 6.78. PIMCO's the biggest. PIMCO is like the State Street, you know, but for bonds, where State Street is, you know, or Vanguard or whatever is the big issuer for stock indexes. PIMCO's a bond company. A guy named Bill Gross, I think he founded PIMCO or worked there for years. He's out on his own, but he's the biggest bond baller in the world. And a real interesting dude, very interesting dude, Bill Gross. Google him, and he moved to California. Just maybe we'll look at that later. I like to talk about that kind of stuff. Maybe we'll check out Bill Gross. But let's get business over with first. He's an art collector. He's a real interesting dude. Worth like $5 billion or something. He's the biggest bond trader in the. At one point, I think he traded for his own account, and he was the biggest bond trader in the world. And then I think he founded PIMCO. I'm pretty sure he founded PIMCO. We'll go look. Anyway, PDX. So that's bonds right there. Now, I just saw an error in the darn factor, and I need to fix that. So PDX really shouldn't probably have been this high because it doesn't really yield 21%. I bet you. It's Claude's fault. Gosh, Claude is an idiot. Claude's supposed to check all this stuff. But anyway, I just added it this week, and I think we probably missed some. There's PDX right there. The trailing 12-month is $4.57. Is that right? Let's go check this out. No, the trailing 12-month is $1.43. Okay, that's not Claude's fault. I don't know how that happened. Let me just fix this really quick before I'm just going to change it manually so it won't be messed up next week. $1.43. Then I'm going to highlight it to remember that I changed it and it's not dynamically updating anymore. I'll go check it next week. Anyway, all right. Yeah, and there we go. That makes a look at that. It's amazing how when you have the right data, you know, because that's what it actually pays, 6.76%. It still would have been ranked high. I mean, it's NAV's up 10%. You know, let's see what it would have been ranked. Which one's the fast? Short term is M. Okay. So M. All right. So M is 0.45. All right. Well, let's go back and see where it would have ranked. All right. Well, unfortunately, it doesn't show. Anyway, whatever. It would have been somewhere on here. I'm just going to take a shot. Let's see if it would have been 30th. Well, we can't see. All right. Anyway, Sorry about that error. WEEI from Westwood doing a great job. This one is really yielding that number. And this is all, I checked everything really carefully. And Claude and I worked a long time on this. I thought we got all the errors out of there, but that one was just, that one's Google's fault, not Claude's fault. That's what Google told us, but it was wrong. All right. Look at Murray still hanging in there. That's amazing to me. But I mean, the NAV's up 15%. What do you do? I mean, this thing, if you're talking recent, it has recent momentum. The parent asset has recent momentum. The child asset has recent momentum. Its NAV's up 15% and it's paying a 35% yield. Now it's super unstable. That's why it didn't rank higher. I mean, you know, it takes a lot of risk to do this, but in any event, like for instance, XOMO is twice as stable as Murray. And I think probably a better ETF, but this week it ranked a little bit behind it, but let's look why. Well, XOMO only yielded 30, so it didn't yield as much as Murray, and the NAV was only up about half as much. Now, sure, it was more stable, but it just wasn't delivering the goods. But anyway, all of these are good. I mean, you know, MDST, any of these could work. I mean, I wouldn't buy Murray with your money, but or with somebody else's money, but EIPIO is on here. This is a new one on the list. Old EIPIO. All right. EIPIO. First Trust. Wow. This is these guys have the second worst looking website in the business, but they have some good funds. Who cares about the website? They have some good funds. Look at that monthly performance. Wow. I mean, this, of course, it's oil energy partners. So this is going to be probably Chevron, Exxon, well, Kinder Morgan, Williams Company, Duke Energy, I was right about Exxon. I missed Chevron. It has Shell, One Oak, lots of good blue chippy type companies in there. This thing yields 6.7%. You could do worse. You could definitely do worse. Okay, so let's see what else we have. Okay, EIPIO, INDIV. INDIV is amazing. I mean, it has a tiny yield, but I think it had better NAV than anything else on the darn list. Yeah, it did. Because INDIV is, maybe I should get INDIV next week. I just don't want to get too loaded up on oil, probably at an all-time high, or I don't know, though. I think the war goes on for another 6 months. And if that does it, I think oil will stay bid for a while. I just need oil to stay bid for 3 months because I reallocate every 3 months. But I think I'm going to be happy with MLPI. I hope I am. Maybe I should get some of this INDIV. They have a bunch of companies here that pay real dividends, and then they sell options on them too. And they're based on oil and gas. So that's why they're doing so well. But all right, YQQQ, I have some of that. SRV. Now, SRV dropping 6 points. It was like number 5th last week, I think, or 7th or something. IGME, I have no idea how this got on here. I mean, I was thinking it was I was trying to throw Claude under the bus, but I went and checked the data, and no, it's not. It's paying a gigantic yield. And its NAV is positive, not very much, but when you're paying that kind of yield, if you have any kind of positive NAV at all, that is pretty good. And it is pretty unstable. It's only a 0.42, but I mean, it's not too unstable. So yeah, IGME does deserve to be on the list. I mean, I would not buy that with Brad's money or Marcus's money. If I had as much money as Brad and Marcus combined, I would buy IGME. But if you look, if you look, the NAV is up over the past quarter. I mean, it's meeting all the rules. The factor tries to filter out the bad ones, but I mean, it's meeting all the rules. And the main thing is the momentum of the parent asset. And it may not look like it here, but 3 months ago, GameStop was at 20 and now it's at 23.30. So that's about a 15%, rise in NAV. So anyway, IGME it is. All right. Then we have TMLP, and then there's a bunch of these MLP investments. We have TMLP, MLPA, MLPD, MLPX, and we've lined these all up against each other a million times, and they're just different. Some of them pay a higher yield, some of them pay a higher or have better NAV return, but they're all pretty much, as far as when it's all said and done, they're 15th, 17th, 18th, and 19th. They're all very similar. The one that differentiates itself in the MLP business is MLPI, which is the reason I got that one. And also because I've always wanted a NEOS product. I mean, I like NEOS products also. I don't only like, Defiance and YieldMax and the riskier ones. I like, Curve. It seems that way, X funds, but I've always been NEOS curious. Anyway, so let's see what else we have. We have Crash, Inverse Tesla, MLPA, MLPD, MLPX. We talked about those. XLUI, this is one also on my to buy list. So that I may get that one on Monday. Anyway, AMZA from InfraCap, whatever the heck this is. I have no freaking idea. AMZA, some kind of infrastructure, or not infrastructure, some kind of, I bet it's got to be oil and gas. Yeah, of course. Jackson, what are you doing? You have food in your bowl over there, buddy. Go eat your food. But yeah, oil and gas, Williams Companies. So back over here to the show. Anyway, HDLB, Foxy, TYG from Tortoise, Poppy, first time on the list. That's doing a good job. From Morgan Stanley, we have NXG, which was higher last week. That one's dropping 11 spots. HTD, John Hancock, what is that? High tax efficient, high income or something. Anyway, it does a great job. SCHD, BUI was ranked higher also. Yeah, BUI dropped 11 spots. Fiat, DNP, UTG, which is the Reeves Utility Fund, little JRE from Janus. GNT is dropping 7 spots. Okay, now look at this one. ASGI is jumping 38 spots. Good job, ASGI. This thing is from Aberdeen, global infrastructure, doing a great job, yielding 11%, NAV's positive 5%, 1 year total return of 46%. Anyway, then we have BCX, DOGG, CSHP. That's also a new one on the list, CSHP. But that's like a competitor for Cashy, maybe, or it's a cash substitute, basically. Really short-term T-bills is what it's based on. But heck, it's yielding 4.86%. That's not too bad. Look at the stable dex on this one. CSHP, that's the highest stable dex in the history of the factor. I have never seen a higher stable dex. Now, Brad's over there saying the PDX just did what now, Brad? PDX just, maybe so it's not an error. Okay, so maybe it's not an error. Is that what you're saying? Maybe that yield looks higher than it really is, but still though, okay. But no, that's good to know. I mean, PDX, I'm not saying it's not a good one, but I mean, I don't think it deserved to be that high. This is saying trailing 12 month of only $1.43. Oh, Brad's right. How can the trailing 12 month? This is wrong. This is wrong. Google was right. Because this is saying maybe the trailing 12 month doesn't count special dividends, which would actually be a good way to do it. That's actually a smart way to do it. I mean, because I can see both ways, but okay. So, all right, I need to fix this now or it's going to be messed up later. Let's take this. But yeah, it does deserve to be up there. Thank you for pointing that out, Brad. Let's take this. Let's reset the fill color and let's drag this back down. All right, there we have it. All right, yeah, that $3 divvy darn sure helped, didn't it? Yeah, good call, Brad. I'm glad I looked over there and caught that. All right, I'll look at those other questions here in a second. Let's finish this list up. But anyway, so that's the list, right? BCX, DOG, CSHP, Soxy. Now, Soxy's dropping 7 spots. Chippy's done. And it's not that there's anything wrong with Chippy. What does Chippy do? It gives you all the yield back. So it has more risk than Soxy. And so Soxy barely made it. Chippy, well, let's go. I guess we could see where Chippy is. All right, so here's the list right here. So the top 40 goes to, okay, so 41 was Renty, RNTY from Yilmax. Good job. And then we have AEF from Aberdeen, IDevo, just barely missed the list, NFLP. That's the highest ranked single stock besides GameStop, which I'm not going to count, and besides ExxonMobil, which is just basically an oil play. That's the highest ranked. In other words, I don't count them unless they're a tech stock. I only like tech stocks. Oh, well. So it's the highest ranked one. That's cool with me, I guess. Anyway, but good job. Curve does a good job. Shouldn't surprise us. ALTY, this got on here because of one of you guys bringing it up in a live last night. Who mentioned it? Yeah, Brad, I agree with you. It is a really good fund. Who mentioned ALTY last night? I was talking about Alt-E and Alt-I, and somebody was talking about the other Alt-E, and they were like ALTY. And so I slapped it right in there and put it in the factor. Yeah, and that one's doing really well. Doing super well. Let's make those a little smaller. All right. So anyway, let's see who else just missed it or just missed a list. The next 10, NFLP, ALTY, IDE from Voya, GGN from Gameco. That one used to be ranked high. Well, yeah, it was 34th last week. So you can see last week's ranking right there. K Gold was 46 last week. It dropped to 48. It's a good one. It's just gold's been pulling back. EDOG was on last week's list. It was 38. SPUT just missed last week's list. Anyway, then we have, what was the one we were looking for? Chippy. So let's just go through some of these other ones. SLJY, this is a new one. VIOO from Vanguard. That's a new one. Riser, man, I like Riser. Stretch is cool. I mean, a lot of people are treating it like it's a bond and it's guaranteed, and it is far from it. I would think of it more like a covered call or whatever, just like covered calls aren't guaranteed. But they, it's good as long as Bitcoin goes up, I guess. All right, or it doesn't go down too much. Jackson, why are you looking at me like that, buddy? What is that about? He just nipped. He went. Come here. You want to make an appearance, Jackson? Hang on, let me let him out of here. Do you want to go outside? Do you need to go potty? Jackson, you have food right. Come here. Let me see you. You have food right here. Is this what you want? You have it right there, buddy. Okay. You have water? Hang on. Yeah. Yeah, he's all set. For a second, I thought maybe he's out of water or something, but you're all set, Jackson. It's cool. Okay, buddy? He probably just wants some attention. All right, let's see who else. Look at old iSpy. iSpy is coming in at 56. DDNQ, my friend Marcus found that one, and it has been a really good one. It doesn't have any yield. It does not belong on the list, though. I need to go scratch that for next week. But anyway, even without yield, it finished at 57. So SPCI from Tuttle Capital, that one is too new to be on the list. Okay, that's Claude's fault. Gosh darn it, Claude. That's an easy one. He's supposed to take, oh my gosh. I fought him all morning. I mean, you have no idea how, oh my gosh. Anyway, all right. But iDubbb's really supposed to be on the list, right? Yeah. K-Spy, I kind of like that K-Spy idea. IAUI, there was a guy that we were talking about in Twitter that was saying IAUI was better than K-Gold, and we were talking about that in Discord. Devo OVS, that's the one that does lightning spreads. Good job, CEFS, that's a good one, an ETF that's a fund-to-fund of closed-end funds. Excuse me. Vega, BCAT, TLTI, where the heck is Chippy? JOF, OVF, ESK, AC2. There, Marcus. There we have a little auto callable action getting in. That's the highest ranked auto callable. Good job there. CHY, BNDI, iGold. Anyway, Chippy just fell off the face of the earth, I guess. I don't know. Maybe Claude dropped. Maybe it's a data problem. All right. Well, anyway, I have the company rankings out if you want to see the company, but there's some good ones. I mean, look at SPY ranked 147th. There's nothing wrong with SPY. It just hasn't been great lately. It's not even being ULTY over the past quarter and a bunch of other ones. It's had kind of a rough quarter, or last time I checked. But you know, there's lots of good ones down here. That triple QI is a good one. I mean, its NAV's down 7% this quarter. I mean, what are you going to do? It's because the Qs are down. You know, it's not triple QI's fault, but even these ones that people think don't have any NAV erosion or whatever, well, maybe not, but their parent asset can darn sure go down, you know. So there's no such thing as a sure thing. There's no free money. As good as triple QI or SPY is, if we get into a bear market, they'll lose money just like the rest of them. Or, you know, if the NASDAQ keeps going down. Anyway, KHPI, that's a good hedged equity one. Big Y is a good fund. Nothing wrong with Big Y, but it's doing terrible lately. It's down 7%, just like SPY and triple QI. So, and it pays a little bit less yield. And so that would explain why it's ranked behind. If you're going to be down 7%, I'd rather get 15% like triple QI gives me than a lousy 12% like Big Y gives me. So I can definitely see why triple QI and SPY are ranked ahead of it, but they're all doing poorly. THQ is a new one this week. S100. Where the heck is Chippy? I mean, my gosh. KQQ is a good fund. It just has had a rough go of it lately, but on a 1-year total return basis, KQQ is running right up there with the parent asset, which is the Qs. There's T-SPY. You guys all love T-SPY, right? It's just, I mean, you know, it's down 9% on NAV only. You know, it pays a 15% yield, but I mean, it's, you know, T-SPY is not free money either. A lot of people always think that the solution to yield max, they hate yield max. They'll always go, you just have to get triple QI and SPY and T-SPY. Those are really steady, good funds, but they can go down also, is all I'm saying. SPY T from Defiance. I mean, that, you know, triple QT, those are good funds, but I mean, it's been a rough month. Look at XPay. There's nothing wrong with XPay. Nothing at all wrong with XPay, but except its parent asset is down. XV, there's nothing wrong with XV. GDXY, I did really well in GDXY. FEPI, there's definitely nothing wrong with FEPI. It's just it's rough for tech. All these are all ones that I like, you know, triple QT, SPY T. I like SPY I like triple QI. I'm in on the NEOs. I like T-SPY. Psychotar is going to be on the show Monday morning, 12:30 Eastern. All right. But I like all these. It's just been a rough month for big tech. And I don't know where the heck Chippy is. I'm beginning to think Chippy must be a data error. I mean, SEPI's a great fund. ULTI is not a great fund, but it is lately. But even as well as it's been doing lately, it hasn't been doing that well. It's still way down the list. Anyway, it's a rough time for the funds I like, whatever. Okay. So let's go look at the company report and the issuer performance report. So maybe I should, how do I make it a full screen? Let me do this. Let me get myself off of here. And, well, anyway, hope that you guys can see that. All right. So in the top 40, I mean, this isn't the best way to rank them. I mean, Defiance just only has one fund, but I mean, yeah, it's one fund is the best fund out of the list. So It ranks number 1. Neos ranks number 2, thanks to MLPI. Nationwide ranks number 3, thanks to old PDX. Like Brad said, it's a good ETF either way, but I like it better this way, though. I mean, that big dividend did happen. Who knows if it'll happen again next year? It's probably not something you want to bank on. You want to think about it paying a regular income of 6%, 5.5% or whatever. But that's a nice little year-end bonus for you. UBS actually had 2 funds on the list, and 2 good ones, USOI and HDLB. You know, look at UBS. They're yielding an average of 15.9, and their NAV's up 70%. The NAV can support all these ones in the top have their dividends are supported by NAV growth. Amplify way supported because InDiv only pays 5% and its NAV was plus 30%. I mean, Amplify could have paid 6 times the yield and had flat NAV. NXG, of course, Bitwise. So YieldMax has 6. So the average YieldMax this week had the average top 40 YieldMax, not the average YieldMax. The average top 40 YieldMax, average yield of 27%, quarterly NAV return of 7%, but that's just for a quarter. So that's about a 28% return for a year. Okay, and they paid a 27% dividend. So what does that mean? It means their dividends recovered. If you had the YieldMax ones, you just had the ones you had Crash, Fiat, Murni, SOX, CXOMO, YQQQ. You could have spent the whole dividend, and you would have had flat NAV. The dividends recovered by NAV, and all of these were. Look at Simplify, only paid a 6% yield, but heck, its NAV return is 10, so over a year that'd be like 40. So yeah, it's like 6 times covered. They could have paid 600% more divvies and had flat NAV. Good job. Anyway, but then there's the rest of them. Global X had 2. Global X had MLPA and MLPX. Those are good. Totally covered. Those are the most covered, right? Well, no, Amplify is the most covered, but Global X is also covering the heck out of their dividends. Anyway, these are all good. That's why they're in the top 40. They need to give me a top 40 average. I need to have them do that next week. It'd be interesting to see how the average one did in the top 40. So, but here is the full company report. So, out of everything, Westwood is the highest ranked. Let me see how they do this. They used to separate it by big companies and small companies, but he doesn't anymore. Like I say, it's a miracle we got this far with them. I got a lot of kinks worked out, I guess. And also I added, we probably added 30 or 40 ETFs, mainly closed-end funds, but some ETFs also. And so we had to get all that straightened out and get all the issuers updated. But anyway, okay, when you look at all companies, Westwood, I mean, their dividends covered 3.8 times. I mean, it's covered by growth. It's growing enough to pay that kind of dividend. They could have paid 383% more, 3.8% higher dividend. In other words, they could have yielded 40% and been fine. NXG just has one company, SRV, but that one's doing well. Tortoise Nationwide has 2 companies. Morgan Stanley just has one. That's Poppy, but heck, Poppy's doing well. UBS has 4 companies for something with, let's count 4 or more companies as a major company. So UBS would be the highest ranked big company. If we're going to make the cutoff 4, sometimes I make the cutoff 5. If the cutoff was 5, the highest ranking one would be Aberdeen. But anyway, we'll leave the cutoff 4. So then on the other big companies we have, but there's a lot of negative, it wouldn't matter. It wouldn't matter if Crane Shares paid no dividend with K-SPY. It still wouldn't be covered because they didn't have any growth in the NAV. They could have. So, I mean, and that's true with all of these. But remember, it's just on a quarter, and it's been a rough quarter. So, you know, that's what I'm trying to say. The SPY and triple QI dividends aren't covered lately. Not this quarter, they aren't. If you took them and paid them, you're suffering NAV erosion. I mean, and they're really good. That's why I keep pointing to them. State Street State Street and Aberdeen are the first really big companies. State Street actually has 12 funds: Spin, Sirloin, XLBI, XLEI, XLFI, XLII, XLKI, XLRI, XLSI, XLUI, XLBI, and XLYI, and also SPUTs in State Street. It's missing SPUT. I need to keep a pencil and a piece of paper next to me when I do this show. How the hell did you miss SPUT, Claude? Gosh, damn it, Claude. All right. But yeah, so State Street, it wouldn't matter if they paid, it wouldn't matter if they paid zero dividends. It was totally unsupported because a lot of their stuff is pulling back on average anyway. Their average ETF has lost 3% in NAV for the quarter. I mean, but they pay a 14% yield. So you're on your average ETF, you've had 17% NAV erosion just this quarter. Not State Street's fault. It's just the way it goes. Peerless with Will, looking good. Not really, but anyway, BlackRock's good. I mean, they have 7 ETFs. They average 13.68, but they didn't have enough growth in their portfolio, at least not as a family. BUI was fine. BUI supported its dividends, but I'm just talking if you look at the family. iShares is a big family. They have BallQ, BREM, HYGH, HYGW, IVVW, IWMW, and TLTW. Paid an average of 11%, but their average fund was down about 3% on NAV, about 4%. Even as good as River North is, it's just they got beat up. Calamos, I mean, that's all those auto callables right there. I didn't realize CHY was an auto callable. Is that really right? I'm calling BS on that. I want to check that. Yeah, it is Calamos. It's not an auto callable, but it is Calamos. Okay. It's convertible high yield income. All right. Well, I mean, you know, remember this quarter started like January 1st. I mean, this one's barely down, but it is, you know, it's been a really bad quarter. That's what happens when we go under the 200-day moving average. When we get back above the 200-day, back in a bull market, a lot of these will be green and shape up again. Nest yield, I mean, Nest yield. Okay, Curve. Okay, Defiance and Curve. So Defiance is actually ranking a little bit ahead of Curve somehow, but it's because Defiance has USOY that's keeping the average up, right? Because none of these other ones are keeping it up. So the average Defiance fund paid about a 40% yield, but dropped 10% this quarter. So the average Defiance fund is giving you about 50%. Well, not really 50%. Okay, it's paying a 40% yield annually. So that means it's paid out 10 this quarter. Okay, and the NAV's dropped 9 this quarter. So the average Defiance fund has had 19% worth of NAV erosion this quarter, even if you didn't spend the dividend, just because of the market. And you could also kind of blame the high yield or whatever, but the average Curve fund, now Curve doesn't pay as much as Defiance. They only pay about 20%. So they paid out about 5% this quarter. All right. But their average fund has dropped 11%. 11 plus 5 is 16%. The average Curve fund has had 16% NAV erosion. And they don't have K yield in here. How the hell does Claude not have K yield in here? Jiminy criminy, Claude. What in the heck? It's not like K-yield would have helped. It's been doing terrible. I mean, it's getting beat by ULTY also, lately anyway. Or since inception, it's getting beat. All right. Well, Vista shares. I mean, it's just ugly. Tap Alpha is as good as Tap Alpha is. The average Tap Alpha fund is about 12% down in NAV, even if you didn't spend a dime. Or no, I shouldn't say that. That is 12% down if you spend it, of course, because I subtracted the dividend out. The dividend's gone, NAV's gone. Yeah, the average Tap Alpha fund's down 12%. But you've got a dividend. So I mean, but that's how much the NAV is down. Let's see here. Simplify. I mean, Simplify is no better. It's paying about 21%. So that's 5% this quarter. And the average ETF of theirs is down 7.6. It's just ugly. Cornerstone, nothing wrong with Cornerstone, but I mean, it hasn't been doing well lately. Amplify right here. Amplify, nothing wrong with it. Just not doing that well lately. X funds, Blocks, FIAX, and GX. The other ones I think are too young, but they'll be getting on there soon. But and so here's the good news. All those ones I just talked about, X funds, Simplify, Tap Alpha, Vista shares, Curve, Defiance, those are all better than average. It's not their fault the market's going down. Those are all protecting your money better than average as far as the company goes. So these are the really rough ones right here. Oh, we can look. So the average for all funds, the average of everything on the list, is your average yield is 41%. But the average NAV is down 11%. So, for all of these, 41% means 10% of the yield is gone because it's been paid out to you. So 10 plus 11 is how much NAV's been lost this quarter. The average high yield investment of all of these on the list, if you're spending the money, is down 21%. Now, but you've got the money. I mean, the money may be helping you other way, but your NAV's down 21%. Is that right? Or no, the NAV's only down 11%. I'm trying to think. But if you spent the money's gone, then you've really suffered. Anyway, it's just ugly on all of these. But then the ones that are worse than average are Crane Shares, Rex, Yieldmax, Round Hill, Granite, Tuttle. Tuttle only has one on here, but that's not right. Tuttle has more than. I don't think Mago and MemeY are old enough yet, but Tuttle should also have MSTK. But I heard they just delisted that, so I'm not going to worry about. Or I heard that was getting delisted. But yeah, the average Round Hill fund or the average Yieldmax, whatever. The average Yieldmax fund pays 70%. The average Round Hill fund pays 90% somehow. Round Hill's like hold my beer Yieldmax, and Round Hill's NAV is a little bit worse too. But anyway, it's ugly on all of these. It is ugly on all of those. The only ones worth the darn that have more than 4 companies is UBS. The only ones worth the darn that have at least 3 companies is UBS and Invesco. Or when I say worth the darn, I mean with where you could spend the dividend and not be killing your NAV. So, all right. So what else do you guys want to look at? I guess we can go back here and look at this. Yeah, it's still dropping down 31 basis points. We're probably going back to at least to check this 66.8. That's kind of the mean, probably a reversion to mean. We got a little bit ahead of ourselves, and we'll probably come back and check the POC, check the previous POC. It happens you see it happening all the time. All right. So what else do you guys want to look at? You want to talk about, maybe let's, I just did these by alphabetized, so maybe we'll look at these in a different way. I mean, YMAG, YMAG is a really good ETF in my opinion, but not this quarter. It's it's doing better than YMAX, but YGold used to be, a few months ago, YGold was always up here. I believe YGold uses a little bit of leverage, and so they've got hit by the recent pullback in gold. I mean, their NAV's down 8%. Here's YBST from Granite Shares. That thing's a hot mess. Paid a 95% yield, and the NAV's down 34%. So I'm trying to think what that means. So if it's a 95% yield, it's like 27% a quarter, 30%. So it's whatever. So you've got 27% paid to you, but the NAV is down 30%. So I guess you aren't down 50%. You're down 30%. You're down 34%. In YBEST anyway. YBMN. Wow. I think BM is the key thing there. YBMN. We'll start calling that one YBIT XYZ. Anyway, maybe we just line them up by companies. Yeah, and this is in the order of how well they did. So the only ones that are doing worth the darn from YieldMax, the only ones that are supporting themselves, Murni, XOMO, YQQQ, Crash, Fiat, Soxy. Oh, there's Chippy. So Chippy was ranked 113th. Well, no, it was 113th last week. This week's it's 135th. So it is dropping. Nothing wrong with Chippy. He just pays this giant dividend, and the NAV's down 3.7%. If you're seriously concerned about NAV, but you like Chippy, just get Soxy. Soxy paid about a fourth the yield, but the NAV's positive. So your money's actually compounding and doing good. That just shows you how math works there, because they're basically the same underline. Winter used to be better. It dropped off the list. Big Y, I mean, even old Big Y's down 7.4. Infly down 9. I mean, some of these, let's see what the worst YieldMax ones are. Hui, RDYY, Dre, Morrow, ETCO. That is not YieldMax. Come on, Claude. What in the heck? There's no way ETCO is YieldMax, right? Who is ETCO? Where did FinViz go? Gosh darn it, Claude. I mean, we can look at all the round hill ones. Let's look at all the round hill. Man, Claude is just freaking retarded. All right, so State Street, we can look at all the State Street ones. XLEI, XLUI is the best, but the next best is XLSI. Its NAV was barely down, but its NAV dropped 1%. But that's not too bad. And then XLBI dropped 2%. That one's good also, materials. So consumer, SI is staples, right? And BI is materials. Anyway, but then Spin dropped 6.5%. And this is where, I mean, this is SPUT is supposed to be State Street. Did I already tell him that? I guess he's updating it over here. Okay, well, maybe I should go get, I should have probably got his new thing because he would go. What are you talking about? He's saying Sput is back to Sprott. Oh, Sput is not State Street. Sput is Sprott. You're kidding me. Why is he arguing with me? Sput is State Street. Right? Oh, no, Sput's Innovator. Okay, well, we're both wrong. We're both wrong. I mean, but he's supposed to be AI. He can look this stuff up. I mean, instantly. I thought, anyway. Man, Claude, you're just a freaking idiot. Simplify. I mean, Simplify has some good funds, but the only ones that did worth the darn this week are EIPI, came in number 10, and Foxy came in 23rd. Good job, Foxy. PFIX was 24th last week, but dropped to 91st this week. There's nothing wrong with PFIX. I mean, but it just didn't have a good week. Y Gold, SBAR, XV, SVOL, Maxi. Anyway, CEFS is the only one we have from Saba. I mean, that's a pretty good one right there. That, I mean, it paid what did it rank? It only ranked 63rd. Wow. But it paying about an 8% yield, and the NAV was only down 0.5%, and it's pretty stable. It's a 0.92 on stable decks. So, all right, I'll answer that question, Jason, here in a second. Anyway, let's go see what Claude's saying. Spud is Innovator fixed. Okay, so I guess I should be doing this. No. Oh, I do want to add that to project. Yeah, let's download this. Anyway, so this should have some of that stuff corrected. But anyway, we kind of got the gist of it. Okay, so Jason's saying if you had to pick 5 funds with high yield but minimal NAV erosion, which 5 would you pick? Well, the NAV erosion, like, it's not really under your control. I mean, like I say, you just have to pick the assets that go up to not have NAV erosion. But the second way to do it is to not pick anything that pays too high of a yield. I mean, they're both contributing factors. So I'm going to say, so let's choose stuff that pays under 20. Or under 15, because anything that pays more than that, I mean, it doesn't mean it can't do well, but it just, I mean, so I'm going to say, so my 5 funds would be Triple QI, Triple QI, well, the other thing is, if you can only do 5 funds, you'd want to do them in different areas. But I mean, because you would either want to pick Triple QI, you'd either want to pick SPY or T-SPY, but not both of them. Either of them could work. So I'm going to say SOXY. But of course, that one's going to have massive NAV erosion once semiconductors go down. I mean, it's not really NAV erosion. The NAV erosion is not really a deal. It's a kind of a different. But anyway, so but. For the condition we're in now, let's say SOXY, and let's say Triple QI, just because I like the NASDAQ. But if you already have SOXY, you probably don't need Triple QI. Maybe SOXY and SPY. So those are 2. And then what else? I guess we could use our tools here. Let's sort it by yield and kind of take a look-see here. So we could do, that's the whole reason I do this stuff is, so we're going to go, there's no way to guarantee no NAV erosion, but we're going to make it easier on the fund. So we'll just choose stuff that's under 15. So yeah, these are all good. T-SPY, Triple QI. I wouldn't take XYLG. But one of the State Street funds would be good too. Anything from State Street would be good. You just have to pick the sector that's going up. That's the way to not get NAV erosion, is the parent assets have to go up. Sorry about that. My bad. Hang on a second here. Share screen, entire screen. Okay. We'll find some good ones in here for you, but I would say definitely one from State Street. Just pick one that's based on the, whatever you like. I mean, you could probably get some closed-end funds like a River North Opportunities Group. I mean, I don't know that much about it, but all these closed-end fund guys like that one. I think Will might be a decent one. So, yeah, I'm going to say something from State Street, something from Neos. Soxy's going to be our one from YieldMax. And Will. I think Will would be a good one. Maybe SBAR. I mean, SBAR is a hedged equity thing. I'm trying to think. Let's look at some other ones here. It just depends. IAUI, it only pays 12%. So as long as gold goes up, that one should be fine. So maybe IAUI, and then maybe something from Westwood that pays 11%, WEEI. So those are my picks. So I'm going to go. So we'll go WEEI, IAUI, SPY, Soxy, and what was the other one? I said maybe River North, maybe some kind of closed-end fund or something. But Brad, why don't you pick a closed-end fund that pays less? Well, all the closed-end funds pay less than 12%. So I'm joking, but a lot of them do. I mean, heck, let's just see what the highest rank one that pays less than 12% or so is. Probably darn NXG or SRV. Or BUI might work. I mean, BUI only pays 10. I'll choose that one. That one's a good one. BUI. What was that? 1, 2, 3, 4, 5. There you have it. But that, like I say, it all depends on, those could be it just depends on what the parent assets do. So, and I was going to say one by State Street. So, for State Street, if you like energy, go XLUI. If you like something else, pick whatever sector that you like. But the State Street is a good one that should have minimal NAV erosion. So there's 6 of them for you. GPIX would have been a good one too. It only pays 8%, so it even has a little bit less chance. The NAV erosion is not a real deal. All it is the dividend coming out. NAV erosion is a highly misunderstood topic. So the ones with the giant dividend coming out are going to have the higher chance for NAV erosion. But if the underlying assets in the fund can outpace the dividend, they can not have any problems for a long period of time. Kind of like Chippy. Chippy for the past 6 months has been great, but it's just because the parent assets have been going up. CEFS might be a good one too. It only pays 8%, but it's a fund to fund with a bunch of other closed-end funds in it, and closed-end funds are steady and stuff. Maybe CEFS could work. Something like that. But yeah, if you stop thinking, I don't think of it as erosion. It's because erosion's a bad word, and the dividend is the erosion. That's what causes the erosion, is the dividend. So something that pays a 50% dividend compared to something that pays a 10% dividend has a 5% harder time of not having erosion. It's just a hurdle to overcome. The dividends a tax on the future upside. Michael, what are you doing here, bud? I'm surprised you don't have any. What are you looking at as far as stocks go? Usually Michael has some good stocks to talk about. Are you still in on, let's see what Michael's in on. He liked this one, PAGS, right? That's one of yours, right? Let me get FinViz back up here. PAGS is Pagsuro Digital. That's bouncing. Michael's into the growth stocks more so than the dividend stocks, if I remember. Michael usually has like stocks that have a story behind them or they've had good earnings or something. And I just remember he talked about this one before, and I just happen to remember the ticker. Yeah, Jason, I appreciate it. I mean, thanks for asking. I love looking at questions like that. But what do you guys in the crowd think? I mean, about these guys have strong opinions. Which one do you think? Which 5 would you guys pick? You can put your picks in there too, or whatever. Hey, Bon, I didn't see your question there, man. Does gold 9 or silver trade? Do you mean on weekend Wall Street? Is that what we're talking about? Does gold 9? But let's just check weekend Wall Street and see what gold is doing, because we should have checked it. We checked everything else. So I think I shut down the weekend Wall Street window to open up the FinViz window. It's a vicious cycle. So weekend Wall Street. So let's get a little, let's see, weekend gold. No. Weekend gold, IG International. It's down about 1/3 of a point. That's no big deal, right? That is no big deal. All right, so let's see what else we're missing out on here. But yeah, just choose anything that pays, that just choose the lowest. If you're really worried about erosion, if it's a big concern, just choose things that pay the lowest amount possible. Like Devo, because it only pays 6.47%. So its underlying assets just have to be up 6.47%. Now that hasn't helped it out lately. It's eroding this quarter. It's down 1/3 of a point. And that's not too bad though. I mean, but the assets still have to go up that it's tracking. Let's see. It's been a while since we've seen what Devo has in it, but Devo or iDevo are good ones. I mean, if I think Will's a good one too. WEL, Devo, something like that. All right. So Devo is trading Raytheon, Microsoft. Boy, Microsoft's been getting beat up. Caterpillar's been doing well. Goldman Sachs, everything's getting beat up this quarter. But I mean, a lot of stuff are bouncing the past 3 days. Apple's been getting brutalized, dropping from, well, not too bad, but JP Morgan Chase, American Express. But yeah, something like iDevo or Devo are also good ones for stability. iDevo has Taiwan. It's just foreign stocks, but Taiwan Semi, Mitsubishi, Alibaba. I never even heard of those. All right, so here's another way to look at Jason's question. It's a good question. I mean, it's actually a good question. Data can address some of this stuff, but without knowing the future, it's hard to, without knowing the future, it's hard to say. But let's just look at the most stable ones. So this just means the stock price moves around the least. Okay, that doesn't mean it can't be a terrible investment. FIAX has not been a great investment lately. It's down 3% this quarter. But it doesn't move around. It's not super volatile. HYGW, not super volatile, pays 6%. MLPD, I mean, pays 13.2% and is super stable. It's 2.23 times as stable as the SPY. Sirloin, that's the senior loan portfolio, pays about 6.5, 6.75. Bondi, super stable, HYGW, Riser. These ones are all boring, and a lot of these are based on bonds, but that's why they don't move around as much. I guess we should have put JEPI on the list. JEPI checks both boxes because it only pays 8.4%, so there's not as much chance for erosion, and it's 1.79 times as stable as the market. So I probably should have put JEPI on your list, but it's really there could be, you could have 20 or 30 funds on that list. I'm giving you some good ideas. This ALTY is new this week. Let's go see what ALTY is doing. Global X Alternative Income. So this is a fund of funds of Global X other funds, but they have SRET. Why isn't this one in the factor? Now this one should definitely be in the factor. All right. But anyway, so Alt Y has some SRET, which is just a dividend fund, Global X Super Dividend. Oh, and it's real estate. I think it's real estate dividends, but in any event, then it has about 20% in QILD, just basic covered call stuff, paying about 12%. That one is in the factor. Then it has some PFFD, which is also in the factor. That one's doing terrible lately, but then it has some emerging markets, which hasn't been looking great either. That one is also in the factor. Then in addition to that, these guys have some regular companies. Whatever this company is actually looking all right. AVA, whatever that is, a Vista Corporation. Portland General Electric looks really good. That's a utility. What's going on there? Like, anyway. But that's Alt Y for you. So let's go check out some other bastions of stability. Okay, so TLTP is super stable. XRMI, my friend Mayer likes that one. Let's see how that one's doing. It's paying about a 12.7% yield. NAV's down 5% this quarter. This one is a strategy where they do covered calls, but that instead of paying you all the money from the covered calls, they use part of the money to buy a put, and it cushions the downside. And yes, it is down 5.3%, but it could be worse. A lot of these funds are down. A lot of these funds based on the SPY are down more than that. So it has cushion downside, but the cushion downside also causes it to have stable price action. It can't drop as fast, and it can't really go up as fast either because of the option strategy on top of it. There's that PFFD that's part of Alt Y. MDST from Westwood Holdings is a good one. KHPI, that's another one that does a caller program, selling calls to buy puts. AC2 from Innovator. That one only pays a 7% yield. It's auto callables. And NAV's only down not even a point. I mean, that one's not the worst looking one either. There's Sput from Innovator. I'm fine. I'm glad we finally got Innovator or Sput figured out. I was telling them, but that poor Claude, I was telling Claude the whole time it was State Street and it was Innovator. Oh my gosh. All right. OVB, overlay shares. That one's pretty stable. It's 34% more stable than the broad market. All these on this list are more stable than the broad market. Omaha, TLTW, EAPI, SPY-H, definitely more stable than the broad market. SPY-H sells calls to buy puts, similar to XRMI or to KHPI. And so that makes it stable. It's 25% more stable than the broad market. Poppy from Morgan Stanley. CanQ is another hedged equity thing, and that is very stable as well. BIT and PPI PFFA. But anyway, any of those ones I just read you, any of these ones from here up are at least 20% more stable than the broad market. And some of these ones up here at the top are way more stable than the broad market. So this might be an area to aim for too if you're looking for stability. All right, so Michael's talking here. Michael is loading the boat on TDAC. Maybe I'm getting you confused with another. I'm getting you confused with somebody else, Michael. I'm sorry. Who am I? I'm getting you confused with somebody, but yeah, that's also named Mike, but it's not you. Anyway, so you're loading the boat on TDAC, T-SPY, and KQQQ. Yeah, those are good ones. Those are definitely some good ones. Let's go look at those. Let's do this. So you got a little TDAC. You got a little T-SPY. And you got a little KQQQ. All right, total return. Let's go year to date. Heck yeah. I mean, the Qs are T-SPY and TDAC are beating the Qs by a little bit. KQQQ is way behind. But if you look at the past year, it's a different story. KQQQ is ahead of T-SPY and TDAC. Now, TDAC hasn't been around long enough, but T-SPY has. So, but now we have to put the SPY on here if we're going to compare. So the Qs are ahead of KQQQ and SPY is ahead of T-SPY, but that's just the way it works. Just because T-SPY and KQQQ pay dividends. So they can't track perfectly because they're giving some of the money away early. But KQQQ really, I mean, to only be behind 24 to 22.5 over the course of a year, that's not too bad. Let's see how QQQI can do. QQQI is not beating KQQQ over the past year. It's still doing really well, but let's look year to date. And QQQI is winning year to date and ahead of SPY and ahead of T-SPY and ahead of TDAC. That's really good. It'd be even better if it was ahead of ULTY. ULTY is much improved lately. Much, much improved. I mean, but ULTY is ahead of all of those. So what are some other good ones there? So what do you think about TSYX? Let's check out a little TS. Now it's yellow. I took Alti off there. I know no one cares about Alti, but TSYX is, so it's levered. So, but it's kind of hanging out down there with KQQQ. Leverage works both ways. What are some other good ones there for you? Anyway, you got some good ones there. So you're Michael from Seattle. Okay. Well, yeah, I'll remember next time. There's another guy, Michael Anthony, and I should have known because he's a bass player in Van Halen, and he's the one that was talking about PAGS. I'm sorry, you must have thought I was crazy when I said you like PAGS. You're like, heck, I don't like PAGS. I like TDAC, T-SPY, and KQQQ. Anyway, Michael Anthony's a friend of the show, and he's in here a bunch. And I saw Michael. You guys have the same initials. Well, I don't know if you're Michael A. Brigo or Michael A. Brigo, whatever, but you guys are MA. So I looked too quick. But anyway, Michael's in here all the time. And Michael always has interesting stock ideas. He's more of a stock guy, but he still hangs out in here. And I like to talk to him. But yeah, I'll remember next time. You're from Seattle. Brad's from Georgia. I don't know where William's from. Seriously, man, I don't know where any of you guys are except Brad's from Georgia. I'm from Austin. But yeah, there's some good ones right there. There are some good ones right there for you. Did you So let's see on some other one. Let's go out a year. I mean, year to date's kind of deceiving. It's been a rough quarter, but it's good to see how these ones hold up and which ones do better. And that's the reason ULTY is spanking all these, because it has puts on all the time. It's selling calls to buy puts. All of these will pass it like it's standing still in an up market. The ULTY does a great job. Well, actually, I say that, but maybe not. ULTY is much improved lately. I just hate that color. Anyway, but if you actually look, when the market was up, ULTY was spanking all of these. So, I mean, by a lot, even spanking the Qs and stuff. And back here in February, ULTY. But anyway, but that's the reason. I think that's with the recent pullback, the puts have really helped out ULTY. I'm not saying it's a better fund overall than Triple QI, but it's been doing really well lately. They changed their strategy again. And since they changed their strategy, it's been beating the Qs and the SPYs since they changed the strategy. And it's been 4 months now. So, but there's other good ones. What about, let's check out a little SPY T action and what about a little XPay? I'm just trying to throw some different ones in that also are pretty safe and stuff. Now, they can't beat ULTY either, but SPY T's coming the closest. So I'm going to take ULTY. I just don't like that yellow. You can't see it. All right. So now, yeah, SPY T of the ones that's not ULTY is doing the best this quarter. Now, but let's go back a year and get a little bit more perspective. And when you go out a year, it's the Q's number 1, K triple Q number 2, triple QI number 3. Then it goes SPY, T SPY, SPY T, and TDAC. Well, but like, it's not really fair. TDAC hasn't been around. TDAC's doing better. TDAC's fine. It's just, it hasn't been around long enough to really compare it to. Okay, seriously, Mads from New York City. Williams from Memphis. Okay. All right. Boy, I like Southerners. Not that there's anything wrong with New York City. There's a lot of people from the South that live in New York City because it's a badass place to live, or they go there to work. Okay. Michael, not Anthony. I'll know this time. Michael from Memphis. Or no, Williams from Memphis. Michael from Seattle. Okay. Michael from Seattle. All right. And Michael Anthony, he's from Van Halen, so he's from California. But anyway, Jason's from Virginia. I like to know where people are from, and I give bonus points to people from the South. I'm just joking. Well, yeah, Jason, I don't know. I'm not one, but maybe one of these guys is. Any of you guys day traders? Jason from Virginia wants to know. I went to high school with a kid named Jason Cowan. I think his dad was an insurance guy. It may have been not Jason. It may have been something else, Jordan or anyway. Cowan, what was his name? He's a good basketball player. Anyway, all right, guys. So I'm kind of running out of stuff to talk about. If you guys want to talk about anything else, we can. It looks like Bitcoin's doing what kind of we talked about. It looks like it's trying to revert back to where it's comfortably revert back to mean. But the good thing is, if you're a short-term trader, a lot of people will try to buy the pullback to here and then play for a bounce. The old check the previous POC. So Jason, if you're a day trader, do you use volume profile? Do you use ICT? What do you use? Are you day trading options? Or are you day trading futures or stocks? I like to talk about all that kind of stuff. I've done a little bit of everything before. But my day trading, I don't know. I like to use options. So I don't like to use stop losses. I just use an option. And instead of buying futures and setting a $500 stop, if I want to do that trade, I'll just go buy future options, and I'll buy $500 worth of future options. If they expire worthless, they expire worthless. But I'll never get my stop run. But every time I go buy stock and set, and set a stop loss at 500, it'll go hit it and then it'll go back the same direction. So what I like to do is I like to go out a week. I like to take a look and go out to like Friday or sometimes maybe 2 weeks, but I like to go out, a week or two at the most is kind of my thing. So Michael used to, but not anymore. Okay, Michael. Yeah, I know you've been following me. In fact, you've been in my comments before. Did I make a video before where I think one of my first videos, you made a comment and I was like brand new. I think it's my third video. If it wasn't you, it's somebody else. And I like quote tweeted your comment, or not quote tweet. I like made a thumbnail and put the comment up there. It wasn't a bad comment. And then I made a video and I explained what I thought about that. And then I think if it wasn't you, it was somebody else. And whoever it was texted me and said, "Hey, thanks for answering my question. But, I'm afraid my comment's not going to get you many views or whatever." But anyway, yeah, but you are an old follower. You and Norman, Tom. Yeah, I remember you guys have been around forever. William is a sideliner for now. Well, heck yeah. I mean, it's the market sucks. I mean, especially if you like playing from the bullish side, I'm waiting for the other shoe to drop. There's no way we don't go lower. There's no way we don't go lower, in my opinion. But of course, don't listen to me. But I think Bitcoin will take another leg down, and when it does, it'll crash the market, and the market will take another leg down. But then at that point, though, once the market does take another leg down, I'm looking for the market to have a day where it's down 5% or 10%, some kind of big blow up. Oh gosh, the troops on the ground have landed. Oh gosh, they're something like that. And then when there's blood in the street, then I have cash on the sidelines. Then I'm going to start buying some bullish stuff again. But I'm waiting for this to kind of get settled out. That's just me. I mean, maybe I'm wrong, but what I'm looking at is I just don't like these bear wedges under support. I mean, or under resistance, whatever. There's overhead supply. If prices get up here, if prices get back in the 100,000, you know how many people will probably sell? I mean, and they did. When it got to 98, they sold the heck out of it. Within 4 days, it was down at, it's something like that's going to happen again, in my opinion. And we also have spots on the chart we need to repair, 50 and at 52 or whatever. So, that would be my ideal. Now, it may not work out like that, but I think that's when I may start getting interested in not just Bitcoin. I'm not going to go out and buy Bitcoin per se, but the Bitcoin is just a leading indicator on the market. I mean, that'll make me start being more interested in the market. But the market, I mean, a lot of people say we're going to get a huge bounce next, but it's going to be a bear trap. So let's talk about that. I always talk about the check the previous POC and then continue in the direction of the trend. And a lot of people do this. Well, the previous POC is at 601. So I could easily see a scenario where we shoot up there, maybe in like 1 or 2 days, because that's just the way it works in a bear market. We shoot up there, and then it'll be a bull trap. In my opinion, it'll be a bull trap, and it'll still be a sell. But we shoot up there, and people will start to think, okay, coast is clear. Let's get back in, and then boom. And it's the same thing that happened in April. So let's put the 200-day moving average on this thing, and I'll show you what I'm talking about. All right. Oh gosh, this thing has just not been working lately. None of them have been. Okay, well, anyway, I know where the 200 is, pretty close enough. back here last March, the 200 was, it was right about like at 4. It was right, this gap, I think it was right about here. Yeah. Okay. So we got under it, right? I mean, we shot down. That was a huge down day. That day right there, that we were down 4% on that day. I mean, not as bad as this day where we were down 6%, but I'm looking for something like this before I start to get interested. Today where we're down 5 or 10%. And I know 10% seems like a lot, but maybe over a 2-day period, look at this one. We were down 6.8. So that's 7. And the day before that, we were down 5. That's 13% in 2 days. That's blood in the street. That's what I'm thinking will happen as soon as the boots hit the ground, or maybe, maybe they shoot down one of our planes and take a pilot hostage and behead him on TV, or something, God forbid, something terrible happens. Israel, maybe Israel nukes Tehran or something. That will, so that's, and I just don't see this situation improving. But anyway, so what I was talking about, a bear trap under, I just don't like these bear wedges, especially when you're in a bearish market, and that's, but anyway, so the 200 was right here. So the thing about this was we were under the 200, then we shot back above. We did the same thing we're trying to do right now. We shot back above, took back the 200-day, but it was still there were still sellers there. And then, we dropped from 490 to 3. We dropped 90 points, and I forgot how bad that was. That was a vicious pullback. I don't see there's any way that we don't have something like that on the horizon again. I hope I'm wrong. Maybe unless peace breaks out, and they open the Straits of Hormuz and we cancel the boots on the ground, we turn around the aircraft carriers and come back here. But even if that happens, the market still has other things going on, but that would be a major help. But so, yeah, that's what I'm kind of looking for. The 200-day, I think this time is right about here. I think it was about 590. So, I could easily see us just doing the same thing as this last time. Just watch out for those bear wedges. We're starting to make one now, but if we, watch out for some pattern like this, and then boom. And then also, so here's what I'm thinking. It's just as far as spots on the chart that need to be, here'd be a good spot to start buying the dip. Possibly. Here's one. Here's buy the dip number 1. And here's buy the dip number 2. I know it seems like a long way down, but if you look at April, and it could easily do that. In April, all Trump had to do was cancel the tariffs to bring the market back. This time, I don't think it's that easy. So that's why else I'm, but those are 2 spots to look for blood in the street, in my opinion. We'll see. I hope I'm wrong. I hope I'm wrong. Tough to make money in a bear market. So here's what I do. My stocks that I have right now, my high yield stocks are MAGO, MEMY, ISSB, ULTY. And I cut everything else. Even the stuff I love, just because you can't make money when the stock's going down. And I probably should have cut some of those too. But the reason I didn't is because I loaded up on YQQQ. So I've got my portfolio so balanced right now that, remember this day right here, whatever day that was, we were down 2.3%. It was either that one or the next one. And they're down, well, whatever. I think it was the day we were down 2.3%. I looked at my high yield portfolio and it was unchanged because I have a ton of YQQQ, and I also have something called ATTR, which is a tail risk fund. And that's like 35% of the account. And then I have a bunch in cash, and because I don't even have that much. ULTY is like only 9% of my account. It used to be like 30%, but I sold it when the market started to go down. I kept selling it at a profit. And MAGO and MEMY between them are like 10%. So that 5 each. ISSB is like 5. So I have and I have QLDY, the lightning spread. I'm a big believer in that one, and that one's been doing poorly, but I'm a big believer in that one. So it'll do great when the market turns around. But yeah, so those 5 funds make up like 25% of the account. Then I have about 35% of the account in inverses and YQQQ and salty. And then the rest is just in cash. I have cash waiting for these. I can't wait to buy blocks back or buy K yield. I love blocks. I love K yield. Or I might even buy some more ULTY whenever we get down here, or some ULTI. I really like ULTI. I mean, I don't really like it, but I mean, when the market pulls back this way, it'll go up fast. So, but yeah, that's what I'm doing. YQQQ, that's a great question, Jason. I love that question. YQQQ, let's take a look at it first of all. YQQQ is from YieldMax, but what they do is it's not covered calls, it's covered puts. So let's look at it this way. YieldMax has QDTY, which is covered calls. So covered calls need the market to go up for them to do well. All right. YQQQ is inverse covered calls, or it's covered puts. So it's a hedge, but it pays a yield also. It pays weekly. It pays a yield. And so the market started dropping really February or something. And this thing is going straight through the roof. This thing was on the MaxFactor tonight. But I have enough of that even though I do have, because yeah, my ULTY hasn't been doing well. It's been doing better than QQQI. It's been doing better than anything. I've been doing better than T-SPY, but still it hasn't been doing well. Everything's dropping. And, and I also have MAGO, and that's not been doing great. And I have a little MEMY. But I have so much YQQQ, and I also have Salty, which is also from YieldMax, and it's also an inverse covered call fund. And but I have enough YQQQ and Salty to offset the ones that I have that are going the wrong direction. So it's just a way. YQQQ is a way to keep bringing income in, but not to, the thing that covered calls are great, but you need the market to go up. So but that's not true of YQQQ. YieldMax is the only company that has inverse covered call funds out. They have 5 of them. They have YQQQ, and that's inverse NASDAQ. They have Salty, and Salty's kind of inverse of Alti, not really, but it's inverse, not literally inverse of Alti, but it's inverse of the Alti idea. And then they have Fiat, Dips, and Crash, and those are inverse Coinbase, Tesla, and then they also have Winter. So yeah, so that's the thing. If you like covered calls, but the market's going down. In fact, I'll tell you what I did last April. This chart doesn't go back that far. Let me show you this. So let's do it like this. Let's put a little YQQQ on here. Last April, I saved myself because when we got off under the 200-day, which is right about here, I loaded up on KQQQ. I was like 25 or 30% of my account was in KQQQ, and the KQQQ went up while a lot of my other stuff went down. But then as soon as Trump tacoed, I cut YQQQ back from 30% to 10%. So, it's been 10%. But then at the first of this year, when the market started going bad again, or even before I knew the market was going to be bad this year. So I think the last day of the year, the first day of the year, I kicked YQQQ up from 10 to like 20. And then in addition to that, I also bought some salty. And salty's been going up as the market's going down. It's inverse though. If the market goes up, it's going to do terrible. I mean, just like a regular cover call fund's going to do terrible if the market goes down. But I got that. And then I also have some, this one, ATTR does not pay a yield, but I just have this as a stabilizer. It's a tail risk fund. It does better when the market goes down is all that means. So yeah, so this tail risk fund right there just kind of creeps up. But if the market really sells off hard, it can go up. It's, but yeah, so those are what I'm using to control my ones that are going down. There's nothing wrong with the funds I have. Mago and MemeY are good funds. Alt-Y is an excellent fund. I like that one a bunch. But you know, when it's bullish and the market's going down, so it's tough. Covered calls are tough when the market's going down. Yes, and I do. What I do, Jason, is, and I explained this a little bit, I keep YQQQ at 10% just to dampen volatility. It was 10, it was like 12% for a while, but I vary it. But then yeah, if we get back above the 200-day, the market's going well, I'll cut YQQQ, I'll cut Salty all the way. Salty's done, and I'll knock YQQQ down from 20% back down to 10% or something. Or YQQQ is like 22%. And Salty's like 5%. So between Salty and YQQQ, I have 27% betting against the market in inverses. But yes, I'll cut Salty altogether, drop YQQQ back down to 10%, just kind of to dampen the downside volatility because it still pays a yield. But then more importantly, I'll take the money that hopefully I made on Salty and the money that I made on YQQQ and the cash I have on the sidelines, and I'm going to buy something like Blocks or ULTI or K-Yield or Top W. I like Top W just fine. I really like Round Hills. I think Round Hill has some good funds. Oh, I really would like to get some Rex funds next time I think the market's going to go up. GIF is one I'm really looking at. Do you guys know about GIF? It's too young to be on the factor. It's a fund of Rex funds. And like I say, it's been doing badly because it's bullish, but when the market starts going up, this one would be awesome. It owns all the Rex single stock funds. So you have exposure to CoreWeave, Robinhood, Eli Lilly, NVIDIA, Walmart, Palantir, Coinbase, Strategy, and Tesla. Yeah, so that's what I'm planning on doing with the cash is redeploying into some good bullish funds at a lower price, but also I'll hopefully have some profits left over from YQQQ and Salty, especially if this turns into like a 6-month ordeal, like I think it will. I'll have some good profits in Salty, or I mean, well, yeah, Salty and YQQQ because they're inverse. But yeah, it's 100% tough to make money in a bear market, and it's not just covered calls. So people say covered calls suck; they cap your upside. Okay, that's true, but if you're retired, how else do you make money besides covered calls? Well, you make money in bonds. You know, a 60-40 portfolio has bonds. Well, lately bonds and stocks move together, meaning bonds are getting crushed also. Look at bonds. Bonds topped out last October, just like Bitcoin did, and have been trending down. So your 60-40 portfolio is doing poorly. But yes, this thing is paying a 4.5% yield. You could have a bond portfolio. You're getting 4.5% yield, but it's just like covered calls. It still needs bonds prices to go up. For a bond's price to go up, it means the bond's yield has to go down. So in other words, when interest rates come down, bonds do well. When interest rates go up, bonds do not do well. But so the other ways that a guy would make money in retirement is just to have bond funds. Well, you know, you're down on this one too. You don't get as much yield as you get from a covered call, and this is going down with the market also. But that's one way to do it. Then a lot of people say, well, covered calls suck. So what you do is you just sell stock that you already own. And that's not a bad plan either. That can work for a lot of people once you're retired. But okay, so you sell stock you already own. So that presumably people that are retired have a 60-40. They have some stocks and some bonds. 60-40 portfolios are down also. because look at VU. I mean, a lot of retirees might have like 70% VU and 30% B and D or something. Well, so just this year, VU has dropped 5%. Okay. I mean, and people say covered calls suck. Okay. So just sell shares in VU. Okay. Well, you're selling shares in VU. You're selling them at lower and lower prices. And then when the market eventually does recover, you'll have less shares to recover with. So what I'm saying, there's no way to get around a bear market. It doesn't matter what you're doing. Some people say use the bucket system and have cash saved up, and that's good. That could work. But the downside to that is if you have a bunch of cash saved up, that cash isn't making money when the market goes up. So, there's no perfect system to support yourself in retirement. And in a bear market, it's tough. And that's why YieldMax is so badass, because they invented this. This is the only product that I know of that is a covered call. That this one, and so there are 4 or 5 products. No other company has an inverse covered calls. There's no other way to make money when the market goes down on covered calls, other than YQQQ and Salty and those 4 or 5 others. There's other funds. You could also buy something like TQQQ, or no, you could buy Jackson. You could buy something like SQQQ, but it doesn't pay a yield. I mean, it will dampen your volatility because it's inverse. But the ones I was showing you were the only ones I know of that pay a yield. So if you're wanting to live off covered calls, but yeah, in a bear market, it's going to be tough no matter what you do. So yeah. Jason said he thinks KQQQ on the way down and TQQQ on the way up. Well, yeah, KQQQ is a good fund. There's no getting around that. KQQQ, you look at it right here, and over the past year, it's barely losing to the Qs. So, but the past year has been mostly bullish. But if you look at it over the past quarter, 3 months, actually, KQQQ is actually not really doing that well. It's actually doing the worst of any of these. Here's how YQQQ looks the past quarter. So that's what I'm saying. That's why my portfolio doesn't drop on the big down days, because I'm overloaded on YQQQ and on Salty. So Salty's the past quarter's up 3%. YQQQ's plus 10.2. Yeah, even the Business Development Corporation, or BDC sector's getting hammered. Yeah. We had it good for a long time. For the past 4 years, you could buy anything and make money, and just everything other than last April. But I'm saying IPOs, SPACs, it doesn't matter. We've really had it good for the past 20 years, other than COVID and 2022 in April. But but that doesn't go on forever. I mean, at some point, you have to be prepared for this. Check this out. All right. So here's the Qs, right? They say markets always go up. That's what people say nowadays. Well, those people that say that have only been trading the past 10 years. And so that's what they say. But they weren't trading back in 2000 like I would. There was a point in 2000, if you bought the Qs, it took you 15 years to get back above water. All right. If you bought the SPYs, which is what most people have. So in other words, you're not in gambling. Just if you have a retirement account, what's your retirement account in? It's in the S&P, right? The VU, whatever. S&P. if you tried to retire in September of 01, it took you till 2007 before you were up a penny, and then it crashed again in 2008, and it took you till like 2012 before you started making money again. You know, and I'm not saying that's going to happen, but markets don't just go one way forever. At some point we'll have it'll flatten out. So, but if it does, I'll just stay in YQQQ. I mean, I'll be fine. Thanks to YieldMax. Mark's in the house. Hey, Mark, what's up? Mark says he mostly buys calls and sells puts to fund his positions in dividend distribution equities. Nice. So you're, yeah. Hell yeah. Now hang on here. Jackson, what are you doing? Let me get Jackson some food there. Michael's saying only Coke and weed, not effective on only Coke and weed are not effective. Well, yeah, you're right. Those prices always go up. Heck yeah. Jackson, here's your food. Hang on, I'm going to get him some more food. All right. And Mark's saying basically he does his own options, right? You buy calls and sell puts to fund your positions in dividend. And yeah. So which dividend and distribution equities do you like? Do you like these covered call ones, or are you talking more about things like Cornerstone and stuff like that? Here's a good example. Everyone says Cornerstone is so great, and it is. It's awesome. It's awesome, but this as good as Cornerstone is, it went from 2007 till 2020 before it started making money again. Nothing works all the time and forever. You know, people act like all you got to do is buy Cornerstone. Well, yeah, the past 10 years, I mean, all you got to do is buy anything the past 10 years. But, you know, and I'm not dogging on Cornerstone, but I'm just showing that as an example of what can happen. The other side to that, though, is if you had it 5 years before that, you were up so much money, you know, but this is just a good case for staying diverse, but, and no matter how good somebody says something is, not putting all your eggs in one basket, because yeah, Cornerstone's awesome. In this line right here, let's make sure it's factoring dividends in. Yeah. And that's data adjusted for dividends. If I took off the dividends, if you took off the dividends, I mean, look how bad Cornerstone's done. It's down 95%. NAV erosion. It's not, I mean, it's a 4-star rated fund, but it pays monthly payments. So it's not really down that much. But if you're trying to live off of it, you know, it's down 95%. I'm trying to think of let's check another fund let's check PDX. I think this is supposed to be a good one. This is the one we were talking about that paid the special dividend. One of these closed-end funds has been around like 20 years or something. It's not PDX. But let's check. PDX has been around since 2019, and it's good. But it lost 80% of its value during COVID. So, I mean, now granted, it's come back and it's doing well lately, but my point is nothing lasts forever and nothing works every time. Yeah, CLM is a good time to buy. Yeah. I'm not dogging on CLM or CRF or C whatever. Cornerstone's really good. Let's look at even something like a lot of people think like JEPI is free money from JP Morgan. Oh, it can never go down. That's a good one. No erosion. Okay, well, let's see. Let's see. So JEPI is... that one is the green. And actually it does do pretty well. Even I was trying to show in 2022 it was down, but not that much. Well, down about 18%, but less than the market. Now, it didn't recover as fast as the market did either. Let's line them up at the same spot. Okay. JetBuy, they brought out JetBuy pretty much at the bottom of 2022. JetBuy came out at a good time, but there, you look how much money you left on the table versus just getting whatever yellow is. Yellow's that darn PDX. Brad's right. That PDX is good. PDX is on a tear lately. All right. But yeah, CRF. Now look at CRF. Going from the bottom, CRF has been outperforming the SPY. That is really good. That is really good. Its recent performance has been really good. Now let's go back to like before COVID. Let's see how far back CRF goes. Okay, but CRF had a problem in 2009. So in 2000, if you had CRF in 2009, I mean, it was really rough, and it didn't get back above water until like, 2020 or something. But now it is doing really well. If you look at it in a recent time frame, it's keeping up with the indexes. Not doing as well as PDX though. Man, that PDX is awesome. I think another good one is BUI. Let's look at BUI. There's some closed-end fund that's been out forever and always does a good job, and I'm just drawing a blank on the name. Okay, so BUI. Now, BUI came out in 2011, though, but let's go back to 2011. Let's line these up, start them at the same spot. All right, so BUI has been a underperformer on the market. In fact, it's out of the ones we're looking at, it's in third place. CRF is doing a little bit better than that one. I think Jackson needs to go potty. BIT, yeah, we could. Has BIT been around forever? Let's check out BIT. No, that's a Bitcoin fund. That hasn't been around forever. Oh yeah, this one maybe. BlackRock Multi-Sector Income Trust is probably what you were talking about. All right, BIT. So yeah, BIT has been out since 2014. Okay, let's go back to 2014. BIT's the navy blue. Line them all up together right there. Okay. BIT is not performing as well as CRF or BUI. All right, Jackson. All right, I got to take him to the bathroom. You guys remember, this is not financial advice. Please consult a licensed planner for all your financial planning needs. Also remember, I don't take a dime from any of these fund companies. My station is viewer supported by generous viewers like yourself. The recent donors have been, and he's not here tonight, but Chad and Oracle and Chris have been my recent donors. Anyway, if you'd like to join your name on that list, you can always go to paypal.me/Max Convexity. I always appreciate that very much. All right, guys, so I'm going to get up here. I'm going to take him to the bathroom. Tomorrow night, we have, yeah, no problem, William. ADX is better. Okay, I'll look at ADX. Hang on. Let's check out ADX. Oh, yes, that's the one I was thinking of. Or that's one of the ones I was thinking of that's been around forever. And there you have it. There you have it. No. Yeah, ADX is actually beating the index, which is tough, beating the SPY. Look at that. Well, let's go back how far it goes back. And ADX is not quite beating the SPY, but over some time frames it is. Starting from 2003, it darn sure is. But still, to my example though, as good as ADX is, it took 11 or 12 years to get back above zero. I'm not trying to scare you guys. I'm just saying, but you know, hopefully we don't have another time in history like that. That was a rough 10 years, you know. As long as things keep going like this, you know, it'll be great. It'll be easy to retire. You can use covered call funds. You can sell stock. You can use bonds. You can do whatever, and it'll be easy to retire. All right, Michael, next time I'll remember that you aren't Michael Anthony. CLM and DRF reverse split after the GFC. Yeah, reverse split, though. It just, I mean, that doesn't, to me, that doesn't, I mean, that's going to happen to any ETF that goes down. They have to do it. If the price gets too low, you have to do it, or else you can't take out margin on it. It's not, I mean, but anyway. All right, guys. Hey, thank you so much. He is getting antsy. You guys have a good day. I'll be back tomorrow. Daily Factor tomorrow night, 8 o'clock Eastern. Be here. All right, guys. Thank you so much. Have a great day.